Welcome, everyone, to Let's Talk Real Estate Investing. In this podcast, we share experiences, knowledge, and learnings from other real estate investing professionals and experts to empower you to build your personalized real estate investing strategy. If you like this podcast, I ask that you hit the like button and also subscribe so that you can get notifications when more podcasts come out. We usually release every Wednesday. My name is Debbie Balfour, and I'm a real estate investing professional and a real estate investing success coach. I coach real estate investors to build a personalized real estate investing strategy and scale efficiently so you can start enjoying not just financial freedom, but time freedom, which we all are doing this for. We are all unique, so each of us, our strategy should be unique to us. I have the pleasure today to speak to Joe Tablan on the topic of how to HELOC your life insurance to protect and grow your real estate portfolio, and a few of other topics wherever this podcast will go. Joe Tablan has been in the financial services industry for over 10 years, and he's worked with entrepreneurs and investors to grow their wealth and eliminate uncertainty. He's licensed in BC, Alberta, and Ontario, and he has helped many people gain confidence in making sure their real estate investing portfolio grows exponentially so they live their best life and tax efficiency along with that. Having been an executive in the hotel industry, totally different prior, dealing with operations and revenues, however, to Joe he's no stranger to that. With amounts up to 20 million, above 20 million, around 20 million, Joe, that you've dealt with and up. So Joe has a knack for numbers and structures, which is nice to hand over to those kind of professionals when you don't, like me. I don't like working with it. Joe has been involved in helping investors with their capital and growing his own portfolio using infinite banking. So he has two sons on the personal side, age 16 and 30, and he loves to travel. He went to Europe this year. I saw on his Facebook page, and also last year. So it sounds like a trend you're going to continue doing with Europe. So over to you, Joe. Tell us a bit more about maybe a little bit of more personal, and then we'll go into your journey in real estate
Hey,
investing.
well, thank you very much for having me, Debbie. It's just such an honor having time to speak with you always, and especially with the new things that are happening in your life, with the new home and whatnot. So, this congratulations again.
Thank you.
Thank you very much for the introduction. That was a great intro. I really don't have anything else to say. No, I'm kidding. Um, for myself, like I said, I was in the hotel industry for 12 years and now doing this for another 12 years. It's really been an eye-opening experience because we're taught a certain way to do things from the time that we get out of college to the time that we retire. And I think that in this day and age, it's been very eye-opening to think that there's other ways to do something. You just have to figure it out and find it.
Yeah, our
And
typical way, like we're taught, is work hard, get that paycheck, put some away in the bank,
yeah, put
more,
into RSPs,
put
sock
it
it
in
away,
registered
put it in
funds,
sale.
and wait,
But
wait for your pension.
exactly. And the thing is, the way that's done before is you jail your money for 40 years and don't touch it. But now there's so many different ways to access money that you have already to put it into other assets that you like to put your money into.
Mhm.
So obviously this podcast is in terms of real estate investing, so that's a really big thing because that's what I like to do as well. And so it has been a learning curve, but I finally jumped the gun last year, and we bought a nineplex unit or apartment building in Ontario, and we're just stabilizing it right now and looking to hopefully refinance that in the near future so that way we can keep that money moving and keep that money flowing,
Mhm.
right?
So, Joe, tell me a bit about, like, our topic is HELOC your life insurance. So what does that mean?
So in Canada, it's funny because it used to be a very well-known strategy that you can actually use your life insurance as a means to access funds. There's a specific type of insurance here in Canada known as permanent life insurance. And how it's structured is essentially you're using it kind of like a bank, or I would say more so like a principal, another kind of real estate or principal resident asset. Because if you have how I explain it is usually if you have a principal residence and you want to go buy a piece of real estate, you're not really going to sell your house to go buy another piece of real estate because that's really pretty redundant. But most people do is they take that asset, which is their house, their personal residence, and get a loan against that house or a home equity line of credit.
Mm-hmm.
Whatever it is, 60%, 65%, they take that money and they go buy the house. They'll refinance it and slowly pay back that house, the loan against that they leaned against this house. So instead
Or
of this
pay, or
house,
yeah, pay, but and pay interest. Like
right?
sometimes you're not even paying it back for a long time until maybe you sell that asset you bought with it, but you're paying
Exactly.
interest, just the
Yeah.
interest every.
Right. And so the interest is simple interest, and it's going to
Mm-hmm.
be a tax deductible on your income because of the fact that you're using it for another asset, right?
Mm-hmm.
So if I take that same structure and all I did instead of a principal residence, I had money in a life insurance policy, I can actually do the same thing, but access up to 90% of the cash value inside my policy and go buy that other asset. Just like a HELOC, I have the ability to pay it off when I want to. Or I can let a death benefit pay that loan off.
Right.
So I have a lot of options on how to do that. And so life insurance has been around since 1874. In Canada, they've given out a dividend every single year. So the growth inside the policy is a tax exempt policy, which means the growth inside of it is not taxable. That's like a TFSA.
Right.
So if we want to keep growing that every single year, we don't want to take the money out. And this is where finding money to invest in real estate or other things that you want to do is essential because now you actually get to keep your money flowing in other assets all the time, as opposed to the old way we were taught, like I said before, we jail our money for 40 years and hope that thing makes money on itself.
Mm-hmm.
So now we have the ability to say, look, we put the money in jail for 40 years, let that thing grow, but we also have the ability to use it for other assets as well. So now we have two assets moving up instead of just one.
So
That's
you borrow on it, just like you can borrow against your house, you're borrowing against your life insurance policy, and then you use that, for your investment and pay back when you can, or like you
when
said,
you want to.
maybe you don't even pay it back, you just pay the interest, and then the payback comes when that policy is cashed in. They pay back how much is owed, and then the rest goes to your beneficiaries.
Exactly. And so therefore you have the ability to create an estate plan. You have the ability to leverage money so that we have tax deductions.
Mm-hmm.
Have the ability to have tax exempt growth in an asset that's pretty much growing every single year. And you basically also have the ability to create your own bank. So those four key benefits really just help your planning, not just today, but into the future, because it helps you generationally, but it also helps you today and it helps you in retirement as well.
So, Joe, you said this money grows. So, like a lot of us are familiar with term insurance,
Sure.
and all we do is pay out, and then if something happens, we get it. Or there's nothing growing there. So, how is this growing?
So that's a great question because the type of perm policy we're using is a permanent policy. So there's two types of
Also
policies.
known as whole life, right?
Whole life, some people do use universal life, but
Mm-hmm.
just be wary of how universal life policies differ from whole life policies because there is a lot more volatility in a universal life policy than there is in a whole life policy.
So the preferred is whole life.
Correct. Correct. Because most banks will lend on whole life policies as opposed to universal life policies.
Okay, so another way to leverage use that as like, as an asset. You can use that as an asset when,
Yes.
right.
Actually, if you're looking at it from a corporate standpoint, if you have a whole life insurance policy in your holding company, it's actually an asset on the books. So if you look at your financial statements, you can actually increase the valuation of your company by having a cash value whole life insurance inside it. So the cash value inside it is actually a positive passive investment on the books.
Right.
Um, but going back to your
How
question,
does it grow? Yeah.
the difference between term insurance and whole life insurance is twofold. One, term insurance is actually a lot cheaper. You can get $1 million for like less than $100, right? But think of term insurance as a term, which is a temporary insurance. Think of it as renting your insurance for a 10 to 20-year period at a locked-in rate. So therefore, it's really good if you have a principal residence, for example, and you're going to you need to have mortgage protection on there. It's a lot better than having a mortgage protection plan with the banks because it's not a decreasing benefit, so it stays that way, but also the rates stay that way for 10 to 20 years. The only difference is that it's only good for a finite amount of time.
Mm-hmm.
So if you're looking at it from, say, hey, I have a mortgage of 20 years, 30 years, and once my mortgage is paid off, I don't need the insurance anymore. Term insurance is there to cover that expense if something does happen. But there's no overfunding those premiums are straight to the cost of insurance. That's why it's so cheap.
Right.
With whole life insurance or permanent insurance, there's an ability to overfund that. Just like you want to overfund sometimes on your
Mortgage.
principal residence, on your
Yeah.
mortgage, right? So that way it goes straight to the principal or goes straight to the equity, and you can borrow that equity right away.
Mm-hmm.
So that's the exact same thing that we're doing here. The difference between term and permanent is that permanent is a certain expense,
What
which
does that mean?
means it's going to pay out guaranteed. The reason being, we're going to die one day. And so that is going to be there whenever we need it, whether we're 45, 55, 105, it's there. Term insurance is good for 20 years. And then basically after that 20 years, the premiums are going to go up because we're 20 years older. So we're locking in our rate for a certain amount of time, where whole life, we're doing that for the rest of our days.
So does that mean that I have to keep paying that premium until I die?
No, not necessarily. We can actually build it so that way we can minimum fund it. So we have clients who are putting in, a lot of money inside these policies on a 10, 5, 20-year basis. And because of the fact that the policy's grown over those years, it can actually carry itself without us having to put any more premiums into it. So when we do that, we can access that money still, even though we've not paid anymore. So we
So
have
when we overfund it, what happens? So how is it? You mentioned this will grow. How
Mhm.
does it grow?
So what it does is goes into something called a participating fund. So the participating fund is a fund made up of premiums from all the policyholders that own whole life insurance with that particular insurance company, and that overfunding or that equity is put into very safe types of investments. They'll put it into corporate bonds, government bonds, and things like that. So it's very safe. And then what happens is it also helps with the performance of the insurance company. When the insurance company does well, because you are an owner of the company, get a dividend.
Right. So we have shares
Right.
in that insurance company.
Right. So you're a policy holder of that particular fund.
Right.
And then when that happens, that's going to basically come back to you in the form of a dividend. That dividend is given to pay up more insurance. which compounds because there's also cash value that's growing inside there as well.
Right. So it's reinvested and
Right. So
now.
think of the dividend, and then you have something called paid up additions. I think of it as a brick on a house. Every year you're getting more bricks in the house, which creates more space in the house, which creates more value for the house. So the more bricks you're getting every single year, the more equity you're able to pull out
Mhm.
when those things are growing, right? And so therefore, because it's a dividend and not a gain, the difference is that they can't take away a dividend if the insurance company doesn't do very
Yeah.
well,
Yeah.
right?
So when we borrow from ourselves, what kind of rates would we be having to pay the interest on? And then what does before we go there, what's simple interest? What
A
does that
simple
mean?
interest is basically if you have a $10,000 loan, for example, at like 5%, the math is there. So basically, you're doing what, 10% of 10,000, so that'd be like $500 a year, right? Simple
Right.
interest, and that's what you have every single year.
Mm-hmm.
It's compounding. It's basically going on itself, right? So the interest is growing and compounding on itself, which you don't want.
No, you only
So
want it when it's coming to your pocket as compounding interest, not the other, not paying it out.
exactly. And just know this is that just because you have a loan doesn't mean if you don't use it, there's no interest on it.
Mm-hmm.
So it's only when you use it that you have the interest.
Right.
Just like a HELOC.
Just like the HELOC, the home
Exactly.
equity line of credit. Yeah.
Right. So when you borrow against yourself, it depends on how you borrow against yourself. Because you can take your policy as a collateral loan with the bank or a policy loan with the insurance company. So both have their own set of rules.
Right.
When you go to the bank, you're going to go exactly just like how you would be borrowing on
Loan.
a HELOC, right? You're
Mm-hmm.
going to go through debt servicing ratio, you're going to go through credit score, you're going to go net worth, all of these things to, a colonoscopy really of your finances to get you the loan,
Mm-hmm. But when
which
you're
is still.
borrowing from your insurance, do you have to go through what kind of checks do you have to go through?
So when you borrow from the insurance company and you have good cash value in there, they have one question for you. And the question is, do you want the money in the form of a check mailed to your house, or do you want it straight to your bank account in direct deposit?
So no colonoscopy
No,
required, no stress
contractually,
tests, no anything like that.
they're obligated contractually to provide you with that type of loan.
Right.
It's in the pro forma.
So a lot of, one of the objections to this is like, well, Joe, it's a lot of money. I got to put money, overpay it to see that investment for it to invest and for me to borrow on it. I don't have that money. So what do you say to that? Are there ways to find money?
I would say there's different ways. For one, planning. Planning your priorities on where you want that money to go. I'll tell you this, Debbie. If I were to buy a piece of real estate versus insurance, I would buy real estate all day, right?
Mm-hmm.
Let's be real. It's way better than insurance. Insurance is not an investment. It's a place to plant your money to have the ability to use it again for other things.
Mm-hmm.
But what insurance does, it just creates another asset on the same money that you have. So now you can just have two assets going at the same time versus just one with the real estate.
Mm-hmm.
That's all it is. So it's not saying it's better, it's just complementing what you're doing.
Right.
But going back to your question, it's really about prioritizing and planning because you can either put your money into an RSP, which is just fine for some people. I don't think it's for everybody because if I'm a real estate investor, I want to keep my money liquid. I want
Yes.
to keep my money moving. And so an RRSP is really just going to jail that money for a finite amount of time, whether it's 10 years, 20 years, depending on your age, because you're going to be 71 someday. And you don't know what the interest rate's going to be or what the tax rates are going to be when you're 71.
And they might, you never know what regulations they could add to it by then.
Exactly. So we're
Mhm.
taking all the risk, we're taking all the investment, we're putting all of our capital and jailing it, but we don't ever have the ability to put it into assets that we like. So the question is always, for me, should I put my money here or should I put my money here?
Mhm.
I have this much money, where should I put it? I just say, well, put it into something here that you can borrow and put it here too.
Yep.
Same money, right?
Mm.
We're just creating more capital by using leverage.
Yeah. And I love the idea of both work. Now you can use the same amount of money for two investments.
Exactly. Same money, right?
Yeah.
It's the same 100 grand. Every
Yeah.
single year, it's the same 100 grand.
Just
So
like you can put that 100 grand into your principal residence and have it come back out of your HELOC and borrow on it. So
exactly,
yeah.
exactly.
So,
You can borrow, yeah, up to 60% of the equity,
mhm.
where insurance is about 90%
Right.
to
And
100%.
again, it's tax deductible for any interest paid. So
Because you're using it
investment,
for
not for
investment.
buying that Ferrari.
No, not I'm not in that market, to be honest with you. I know there are a lot of people who look at infinite banking as that type of way.
Mm-hmm.
I look at it as, if I'm going to be borrowing money, I better be making money on that money
Mm-hmm.
to cover my expenses, right? So that's why real estate was so good back then, because our loans were at 2%.
Yes. Oh yeah.
Well, why would I want to pay off my mortgage so fast
Mm-hmm.
in where I can make 10% on this real estate property or 6% on this real estate property on a cap, and it only cost me 2%.
Mm-hmm.
Right? So
I don't think we'll see those kind of numbers for a
I
long time
I
again.
don't think so anymore, but
I don't know if I will live long enough to see those kind of
no,
numbers
no. I think we're getting in a good better spot, definitely, but I don't think we're gonna see that
again.
1.99% anymore.
Yeah.
Just
So
like, well, I don't think we're gonna see the 0% anymore from like
so
2008.
yeah. So Joe, we talked about some like ideas of finding money in like in what you have today. Like so what are some of the tips for finding money that's where you like in your daily life that you can start putting away for investing?
For one, here's a few. Obviously, the big one is budgeting, right? Paying yourself first, taking a look at that, and just putting that away where it needs to go. So devising a plan. So obviously having a good financial advisor that's going to help you with the budgeting side to get you where you need to go and prioritizing things. I'm never going to say that you should be going on a financial diet where, okay, you know what? Don't buy that latte because I mean, you work hard every single day. If you want a latte, go buy one, right? You shouldn't have to go on a financial diet to be able to create financial freedom. But look at your what you spend and see if you value what you spend. I always look at it as, if you don't watch Netflix ever, but you have the subscription, why do you have it if you've never watched it? If you watch cable TV, why do you have cable TV when you watch maybe one channel, right?
Mhm.
Like, just look at that in terms of your
Get rid of those subscriptions that we once used and
right,
we're not using it, but we're still paying every month.
and it adds up. And so
Mhm.
that's a basic one. Taking a look at what you value and either negotiate that value, be it your cell phone bill or whatever it is, or
Ask for the
get rid of it.
loyalty department. As a
Exactly.
person
Well,
that's
yes.
recently worked for telecoms, just go cancel and they'll take you to the loyalty department and you'll get that's a way to get
Right?
your your buddy your subscriptions there to
Mm,
down. Threaten to leave.
right. Another great tip is, here's something I learned recently, and I use this all the time, is that the government treats businesses better than people.
Mm-hmm.
So if the government treats businesses better than people, why don't you, as a person, become a business? So I'm not the biggest person where, these MLMs and things like that are around, but they do serve a purpose because it gives us a way to inject capital that we don't really, like a small piece of capital, like 200, $300, and then we can create a business. By creating a business, you have access to all these tax deductions and tax write-offs. And we do have, for example, I give that to all my clients because you have the ability to write off this laptop that we're on, the
Mm-hmm.
place that you're sitting in right now, the cell phone that you called me on, the car that you drove to get to this office.
The
You have,
internet that you're using.
exactly. All of these things are now tax deductible by you having a sole proprietorship or a corporation.
Mm-hmm.
And so that will actually deduct your income that you're making. Even if you have a side hustle, you have ability to do that. That's the great thing about Canada is that they do value entrepreneurship.
Mm-hmm.
So by having that, yes, please be reasonable. And yes, disclaimer, talk to your accountant. But you do have the ability to have these tax deductions, which will create more money for you
Mm-hmm.
as the year end comes around.
I thought that was such a great tip though about, getting one of these ones that are already have business numbers, etc. Because for me, I've got three corporations, right? So I don't have to worry about that. But for someone just starting out,
Right.
it's something like Avon or, Lego
Amway.
Shield and,
Yeah, legal shields.
yeah,
Exactly.
which I love
Yeah.
actually.
Yeah.
But it gives you it's got a name for itself. You've got a business number that you
Right.
don't even have to go and create your own
Yeah.
against. And you could be like, you don't have to do it like full on. You can just do a little of it. You could be like really lousy at sales. So just like any business, you could be a
Yes.
negative, um but
And
you'll be able to write off things.
exactly. And thing is, that's a really good point because most people look at it, well, I have to make money in the first year.
Hmm.
It's like, well, how many businesses fail in the first 2 years?
Hmm.
And how many people actually start the business at a minus $1 million because they,
Inject their own money into it.
inject their own money into the coffee shop, into the
Yep.
retail store. They haven't even opened.
No, marketing costs, like all of those things.
Right? And
Yeah.
so all of those going to cost millions. But
Hmm.
here you are, for example, take Legal Shield,
Hmm.
and I think it was what, like $100 or something like that to
Well,
join.
it's $49 to become an associate, and then
Exactly.
there's a monthly fee of 24.95 to get your back office and that sort of stuff. But
And now you have the ability to have all the tax write-offs. You have to get to help people with their wills and trusts and things like
yeah.
that. And
And
they,
you can write off meals with your family and say, "Hey, I'm telling them about Lego Shield." Awesome. So we've got that to budgeting, like looking at your budget. We talked about in your budget getting rid of those things you no longer use. Like subscriptions is a big one. Um, Donations is another one. Like at the time you might have wanted to do like just a small donation, but you ended up signing up for years with
right.
that coming out. So and
Mhm.
then the second one we talked about looking at maybe one of these MLM kind of businesses, something that maybe that you believe in, of
I would say
course, but
yeah, something that you'd start off with,
mhm,
that you may want to take up as a passion. I always
yeah.
say that if you're looking at it, and this is just my own 2 cents, and I think that if you're going to be a specialist in something, I don't think you should be part-time in it.
Mhm.
So, for example, if you have a Melaleuca or something like that, like that's good because the fact that okay, it's a retail store, it's fine. But if you're going to be, say, a financial advisor, I don't think that you should be part-time as a financial advisor dealing with people's life savings,
Yes.
right? So really
Yeah.
just choose something that you want to be passionate about and you
Would be
think you're
okay
going
with
to be moving with.
a, s-
Exactly.
a
But if
side
you
gig
don't
too.
feel
Yeah.
that way, you say you're a nurse and you have a passion for nursing, but you just want a side hustle,
Mhm.
I wouldn't want to, with all the regulations of those things, I don't think you should be in a particular, like for example, financial advising.
Yes.
There's so many nuances about
To
it,
do something, yeah. But
right?
they, but
But
there, this is opportunities to have, like, have, say, I have a business, and then we were able to write off. We were able to
ex
write off,
exactly,
a lot of things, and so pay less taxes, and the money that you're paying less taxes, now you've got money to invest,
you find more
to
money,
put into your life insurance,
insurance or real estate,
your
whatever it is
permanent
that you want to do.
insurance policy.
I
And
think
that,
the last one, and again, this
mhm,
is not really in terms of, it's really just trying to find more money to invest with, is it's really true when they say your network is your net worth, because there are people out there that are willing to lend you money for that possible real estate investing, to do a joint venture or JV partnership, to do his GPLP type partnership. There's other people who are just like doing private lending. Like there's so many ways to take a look at that. And I would say that take a look at your people, because a lot of them have money stuck in an RSP that they don't know how to actually access it for other things. So if I have an RSP of say 100 grand, and Debbie needs a down payment for, or some sort of mortgage for a second mortgage for a real piece of real estate, well, we'll both win.
mhm.
But we should be, don't be scared to ask, because you just never know what people's situations are going to be. And using Olympia Trust or using Canadian Western Bank, uh, they have the ability to self-direct those RSPs to other things. And so I know, our conversation about trying to find money to invest in, these are great tips to have by organizing ourselves and finding it. And I always say, lay everything out of all your resources, and then figure out the best possible path to get to where you need to go, whether that be putting up a business, whether that be doing more budgeting, whether that be looking at your net worth. However it is, take a look at all those resources, say, okay, this is what I need, this is what I need, this is what I
So Joe, you told me something interesting, getting back to like the whole life.
need.
Another way, so for me, it's super expensive for me to get insurance right now because I'm old. But it is possible. There's another way within my family to be able to do that.
So you can, we've had some people who want to put money towards their children. And
Mhm.
so because children, uh, the cost of insurance is a lot less. And so if you're looking to put something together, like a savings plan or some sort of foundational asset for your kids, this is a great foundational asset. I always look at it this way. If you're looking at education and only education, this isn't for you. I would actually go with the RESP, which is a registered education savings plan, because you do get some benefits and some grants available, but it's only good for one thing:
Education.
education. If you don't want to give them anything else, you don't want to help them with a wedding, you don't want to help them with a car, you don't want to help them with a business or a piece of real estate, go with the RESP.
Well, I would definitely tell everybody not to go with
Yes.
RESPs
But
from from my full experience, because I put all this money into RESPs, and the grants that came out, like I put $30,000 away from both my boys each,
mhm,
and what I got in grants was like $1,000. That was
okay,
it, right? That actually came from the government part. So it's not that great. And it's tied into the RESPs. And both my sons have no interest of going to post-secondary school. They're
and there,
entrepreneurs,
mhm,
right? They're self-taught, or they buy books, they get coaches, and those coaches that's not, can't be used. RESP can't be used for that,
exactly.
only formal education.
And if you're looking at it from a formal education standpoint, okay, fine. But if you're looking at, say, a Sauder School of Business to do a 1 year course to be a realtor, you don't really need an RESP to do that,
No.
right? But my point is that, yeah, if you want them to have an education, it's education of us, do the RESP. But if you want something that's a little more flexible, has more options available for our kids in the future, this is a great tool to do it in. And
But they
added
can use
bonus,
it for they can use it, take more of the money for education.
exactly. And I think the best, the one um, benefit that people don't realize is that you as a parent control this asset.
Yeah, that was
You,
the part I liked.
yeah. So if your kids were sitting on the couch and just watching TV and doing nothing, you have the ability to show them, hey, we have this money here for you, and we don't aren't going to give you any until you buck up. But all the while, though, you have the ability to use this money.
So I can borrow on that
Yes,
at a cheaper premium than myself
because you are the owner of the policy technically, and you are the
until
one who's funding it.
we hand it over to them.
Exactly. So you can hand it over. Just make sure that you hand it over in full. You don't want to have all the loans and the cash value
Yes.
diminished and things like that, and say, okay, here you go, we'll give you some loans and things like
But
that.
when you have little ones, like, you don't have to hand it over like,
No,
until they're adults. So you can borrow on that, invest in real estate, pay it back.
exactly. So you have that ability to do that, and I mean, we don't have to have a lot in there for it to be something.
Hmm.
But if you're going to be using against it, at least this way you have the ability to have excess funds if you need it, right? It could be a couple of $1,000. You could use it as an emergency fund. You can use it for that, right? A lot of the real estate investor clients that we have, just another side note here, will actually use a whole life insurance policy on the instead of a savings account. So, for example, when you're doing your financial, you have some money from your rents to go back to capex. You have some put away for vacancy rates instead of someone isn't there. At
Hmm.
least you have money there. So they're putting that as their emergency funds on a monthly basis, and then they put it into a life insurance policy because it keeps growing on a tax exempt basis. And
Hmm.
if they say, "Oh, I need a new boiler," they can literally just take it
Sure.
from their policy, go buy the boiler, do what they need to do, refinance it, and pay back that loan whenever they need to,
Hmm.
right? Because you never want to just because you took $1,500 to $2,000 out for a boiler doesn't mean you should stop replenishing the emergency fund,
Yes.
right? You should pay it back.
Hmm. Yeah.
So that's how they use it. But going back to the children's thing, cost of insurance is so much lower for them. They don't need the money till they're adults anyway. So you can actually take advantage of their age and put insurance on them that you're going to give to them anyway,
Hmm.
right? So now you're creating generational wealth, um, not just one, but two, three generations: yourself, your kids, and your grandkids.
And I think that, like you said, years ago it was popular, and then kind of this, like, people aren't as familiar with the permanent insurance anymore. But there are adults today, or some adults today, that their parents or grandparents had started an insurance policy for them, and so you should actually check and see what
If you have
insurance you
one,
have. So
yeah,
I
I
think I
actually,
sent you one of my clients
yes,
to go
I,
through his portfolio because I think he had some whole life in there.
yes, yes. So we did all the insurances and things like that. Everything was peachy, like it was. We did some. I think we did pretty good work, and then all of a sudden we found, hey, what is this? And you'll be surprised how many professionals I have that have that, especially not to call out any communities
Names.
here, but the Asian communities,
Mhm.
there's a lot of insurance policies and that they don't even know that they have. And it's just sitting there,
Mhm.
growing cash value, right? I would say keep the policy moving if you can, because you already have a head start,
Yeah, that's
right?
great.
So they just
Awesome.
didn't answer it. They just didn't transfer it over.
Yeah.
Finally.
Thank you so much, Joe. You have a freebie to offer our audience. Can you tell us a bit about what that is?
So we actually a lot of the time I'm getting a lot of questions about, okay, how do you do financial planning? How do we do budgets? There's so many things to consider: estate planning, life insurance, all of this. I don't even know what it means. How do we access this information? So I actually put together an ebook that covers all of it. You want to talk about whole life insurance, universal life insurance, term insurance, critical illness, RRSPs, TFSAs, real estate planning. How do you have a will? Well, we have a wills package for you that you can go and then go to a lawyer, or you can go to Legal Shield or something like that and
Mhm.
just get your wills done. But it gives you the information that's available to you. You have a budgeting thing there. All of it's in there. So there's a lot of links to this type of ebook. It's more of an interactive ebook than just reading information. And we're giving that out for free. And we want to share how I do planning for my clients. And
Awesome.
so I can send you the link and send it to whoever is interested here. You can post it wherever you need to do. And basically, we just need an email address and from there and a name. And then you get the ebook and try it out yourself, see if you can do it.
We'll post it in the video. So we'll put it in the video. We'll edit it into this video for everyone. So you'll have that what that link is. And Joe, how do people contact you?
They can go to my website. So we do have a website, and all my socials are available there. So it's clearpointwm.com. They can reach me on my email. Obviously, just if they have any questions, joe@clearpointwm.com, as well as, like I said, I'm on all the socials. So Facebook, Instagram, um, LinkedIn. We're just looking at TikTok and possibly YouTube. We haven't gone there yet, but that is I put it out there because now I have to do it.
Yes. That's next year's goal, right?
Right,
Next year's
exactly.
challenge. So that's awesome. So thanks so much for your time, Joe. We will put that information also into the video for everyone's information so that you can contact Joe. But thank you so much for your time. So I really appreciate it. Thank you for all the great tips. And thank you for making the infinite banking concept simple for us
Mm,
to understand how to use our whole life insurance and
thank
be
you so
your
much
own
for having
bank.
me. Definitely. Thank you so much for having me, Debbie.
Okay, bye everyone. And don't forget, hit that like button and subscribe.